Tonight I'm going to talk to you about this book, A Beginner's Guide to the Stock Market by Matthew R. Kratter, I believe. Well, it's on the screen. This is a basic book about the stock market, something that I needed to read. And I've also read this book too. It's pretty good, The Nuts and Bolts of Investing. But tonight I want to talk to you about the beginner's guide to the stock market. The stock market is the greatest opportunity machine ever created. But this is a complex system. That's why you need to learn how the stock market actually works. See this right here? Stock market. What is a stock anyway? A stock is a share of ownership in a company. When you buy a share, you become a share owner. The stock market is a forward-looking mechanism. The stock is skating to where the company is going to be in a few months. This guy is forward-looking. Investors buy and hold stock for many years. See, an investor is a person or entity who commits capital, which is money, with the expectation of financial returns. Traders like to buy and sell stocks more quickly, maybe hold them for an hour, a day, a week, or even a month. Stocks are bought and sold on stock exchanges. That's Wall Street right there. The most well-known stock exchanges in the U.S. are the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE is best known for its blue chip or high-quality stock like Coca-Cola and McDonald's. And the NASDAQ is best known for tech stocks like Netflix or Apple. See this? This is NYSE and then NASDAQ. As an individual, you cannot trade directly on a stock exchange. You will need a broker or a brokerage account. In the U.S., well-known brokers include Charles Schwab, Interactive Brokers, TD Ameritrade, TradeStation, Fidelity, and E-Trade. All right. The author's favorite, though, is Robinhood.com. Robinhood is a platform that lets you trade stocks, options, ETFs, and cryptocurrencies without paying commissions or fees. Now, I have not traded stocks yet, but when I do, I'm going to Robinhood. All right. Once you've opened up your brokerage account, it's time to buy your first stock. When you are buying a stock, you will be given a choice of using two different kinds of orders, market order or limit order. See that picture right there. The market order tells the broker to get into the stock as quickly as possible, regardless of price. If you use a market order, you might end up buying the stock at a price that is far away from where it last traded. This is because every stock has a bid price and an offer or ask price. The bid is the price at which someone is willing to buy the stock. The offer is the price at which someone is willing to sell the stock. The distance between the bid and the ask is the bid-ask spread. See this right here, and then this picture. See that? The bid price, the mid price, and the ask price. You see? A limit order is the second type of order. Limit orders set the maximum or minimum price at which you are willing to complete the transaction, whether it be buy or sell. There is also the stop limit order, which the book doesn't mention, I don't think. And this combines features of both the stop order with that of the limit order. See that right there? When you place an order to buy or sell a stock, you have to decide if it's going to be a day order or a GTC order, which is good till canceled order. Day orders are limit orders where you buy or sell securities that are only good for the remainder of the trading day on which they are placed. This type of trade is automatically canceled if it is not executed within the same trading day it was placed. This means that if the order is not executed by the time the market closes for the day, it will be canceled and not carry over to the next trading day. Now, the good till canceled order is slightly different. This is an order that is working regardless of the time frame until the order is explicitly canceled. GTC orders are an alternative to day orders, which expire if unfilled at the end of the trading day. So, despite the name, GTC orders do not remain active indefinitely. Most brokers set GTC orders to expire 30 or 90 days after investors place them to avoid long forgotten orders suddenly being filled. You see, so the GTC orders expire, within 30 to 90 days, something like that. So they're a little different than the day orders, you see. So after you've opened your brokerage account, you're ready to buy your first stock, many investors choose to buy an index rather than a single stock. An index or index fund is a collection or basket of stocks. So what is an index fund? As you can see in these pictures, for instance, this is a fictional USA 10 index fund that holds the 10 largest U.S. stocks would look like this. See? Interesting. If we take the 500 U.S. stocks with the largest market cap and put them in a big basket, that basket is called the S&P 500. Indices like the S&P 500 are market cap weighted, which means that the companies in them that have larger market caps are given higher weightings and thus have a greater influence on the index. S&P stands for Standard & Poor's. Two other indices are the Dow Jones Industrial Average, or the DJIA, and the NASDAQ 100. Let's see here. I don't know if those are big enough, but you can see. I'll do this. See that right there? Dow Jones Industrial Average. All right, so the Dow Jones Industrial Average always contains only 30 companies. If a company gets kicked out, another one is added. The 30 Dow stocks are called blue chips or blue chip stocks because they are large, mature, profitable, and fairly stable companies. Now, the NASDAQ 100 companies are considered blue chip companies, but they also contain tech companies. I don't know if you can see that. Let's see here. Let's see this. Adobe, Airbnb, and so forth. An ETF, or exchange-traded fund, is a basket of securities that trades on an exchange just like a stock does. ETFs can contain all types of investments, including stocks, commodities, or bonds. ETFs offer low expense ratios and fewer broker commissions than buying stocks individually. An ETF is just like a stock. You can buy or sell it all day in your brokerage account, and each ETF represents a certain index. The ETF for the S&P 500 trades under the ticker SPY or SPY. The ETF for the Dow Jones Industrial Average trades under the ticker DIA. And the ETF for the NASDAQ 100 trades under the ticker QQQ. All right. SPY ETF. The SPDR S&P 500 ETF Trust is one of the most popular funds. It aims to track the S&P 500 index, which comprises 500 large-cap U.S. stocks. See that? All right. You can create passive income with dividend stocks. A dividend stock will usually make a cash payment into your brokerage account every 3 months or every quarter. that cash amount is called a dividend. Investing in dividend stocks is one of the best ways to build wealth. The author says you don't need to have a high salary to become a millionaire. You just need to spend less than you earn and invest the rest in dividend stocks. So you can pause the screen and look at these things. According to Investopedia.com, these are dividend-paying companies. You know, basic materials, oil and gas, banks and financial, healthcare and pharmaceuticals, and utilities. By the way, Investopedia.com is a great site to go to. I highly recommend it. And that's where I got these little blue pictures right here. I got them from there. Value investing in PEs. At its basic level, value investing is about buying something for less than it is worth. PE is a company's price to earning ratio. The author uses an example of a company's stock trades for $100 and that the company earnings per share, EPS, $6.50 over the last 12 months. So we calculate a trailing, which is the last 12 months, PE, which is price to earning ratio, for the stock by dividing the stock price, which is P, by the EPS E. So 100 divided by 650 equals about 15. We can say that this stock has a TTMPE, or trailing 12 months price to earning ratio, that's what this stands for, of 15. This is a good average for a stock. Companies that are growing their revenues or earnings quickly are growth stocks, and these tend to have PEs above 25. See this right here. And now we move on to growth stocks, which, I guess I have a little bit of information on it. A growth stock is simply the stock of any company that is expected to rapidly grow its revenues or earnings. Let's see. Great companies that are rapidly growing will always trade at high PEs. The author likes to buy growth stocks that are hitting new 52-week highs or even all-time new highs, which is smart. He says to never buy a growth stock if the company is trading below its 200-day moving average. There's nothing more dangerous than a growth stock in a downtrend. You can look at this here, this PE ratio. Now, knowing when to sell is more difficult than buying, he says. Here are some suggestions. Take profits when you are so excited and happy about your trade that you are losing sleep. Take profits if a stock moves up 100% in 2 weeks or less. And before I conclude, I'm going to talk about 5 mistakes that beginners make. 1, don't buy stocks that are hitting 52-week lows. You don't want to do that, see? Don't trade penny stocks. These are stocks that are under $5. I think it would be fun to trade penny stocks, or just try everything, see how it works. Don't short stocks. Now, this is something I would not do. In order to short a stock, you must first borrow shares of the stock from your broker. You then sell those shares on the open market, blah, blah, blah. And you can see that right here. See that? I don't know if that comes in clear enough, but. And 4, don't take on margin. I wouldn't do this either. When you buy a stock on margin, it means that you're borrowing money from your broker in order to purchase more shares of stock than you would normally be able to buy with just the cash sitting in your brokerage account. I just wouldn't do that. All right, let me see that right there. Different types of margin. And 5, don't trade other people's ideas. Never place a trade based on something you read in Barron's, Forbes, or Wall Street Journal, or something you've seen on CNBC. And never buy a stock based on an analyst upgrade. And in conclusion, be patient. Don't force a trade. Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. So you want to buy the strongest stocks that keep moving up. Add to your winners. Get rid of your losers and don't get too greedy. And there's the book right there. I guess I can't bring that up. So, yeah, obviously this is the book again. And if you have the time, read this one as well. Nuts and Bolts of Investing by Carol Jones. So that's all I got. I hope that helped. You know, maybe some random person is wanting to learn about stocks and they come across my video. And if you have, I thank you for watching. Bye.